You wake up on a normal weekday. Your alarm rings. You check your phone. The market is down. Your company sends an email. Town hall at 11. By Friday, your job is gone. But here's the uncomfortable part. The crash didn't start that week. It didn't even start that year. It started quietly, years earlier, in places you were never invited into. And every time this happens, every crash, every recession, every once-in-a-generation meltdown, workers lose first and recover last. Not because they made bad choices, but because the system is built that way. And right now, that matters more than most people realize. We live in an economy that looks strong on paper. Markets hitting highs, GDP growing, corporate profits breaking records. But underneath that surface, the same fragile structure that caused past crashes is still in place, just updated, just faster, just bigger. To understand why workers always take the hit, we need to rewind, not to a crisis headline, but to how money actually moves when times are good. In a growing economy, money flows upward. Businesses borrow, investors invest, banks lend, asset prices rise. If you own assets, stocks, real estate, businesses, growth feels exciting. Your net worth grows while you sleep. If you work for a paycheck, growth feels quieter. Your salary increases slowly, if at all. But everyone feels okay because jobs exist, credit is cheap, and optimism is everywhere. This is the calm part of the cycle. Here's the key detail most people miss. Workers don't benefit directly from rising asset prices. They benefit indirectly through jobs. That sounds small, but it's everything. Because when stress enters the system, indirect benefits are the first thing to disappear. Now add pressure. Interest rates rise, costs increase, demand slows, debt becomes heavier. Companies don't panic immediately. They do math. Revenues might fall next quarter. Debt payments are fixed. Investors expect returns. Something has to give, but not everything can. Debt contracts are legally protected. Bond payments come first. Shareholders expect stability. Workers are flexible. From a balance sheet perspective, payroll is not sacred. It's an expense. So the first reaction isn't chaos, it's efficiency. Hiring freezes, overtime cuts, contract workers quietly let go. No headlines yet. This is why workers get hurt first, because labor is the shock absorber of the economy. Then comes the moment things break. A bank fails, a market crashes, a credit freeze hits. Suddenly, the system stops trusting itself. And here's the brutal rule of financial crises. When trust disappears, cash becomes king. Banks stop lending, companies stop expanding, investors stop risking, but workers can't stop needing rent money. This is where the timing mismatch becomes deadly. A company can pause investment overnight. A government can delay spending. A billionaire can sit in cash for years. A worker misses one paycheck and the damage is immediate. Savings drain, credit cards fill up, stress compounds. This isn't accidental, it's structural, because workers are positioned at the very bottom of the payment chain. When money enters a company, it flows in a specific order. First, debt holders. Interest must be paid. Second, suppliers and fixed obligations. Third, shareholders, protected through buybacks, dividends, or bailouts. Last, labor. And when money leaves the system during a crash, it leaves in reverse. Labor goes first. Here's the irony. When governments step in to save the economy, they're usually saving the top of that chain. Banks get liquidity, markets get support, corporations get credit lines. This prevents total collapse, which matters, but it also means asset holders stabilize faster. Markets recover long before jobs do. You've seen this pattern before. Stock markets crash in March and recover by August. Unemployment spikes and stays high for years. That gap is not a coincidence. It's a reflection of whose losses are considered systemic. A failing bank threatens the entire system. 1 million unemployed workers threaten social stability, and those risks are treated very differently. After a crash, recovery begins, but not evenly. Companies become cautious. They don't rehire quickly. They've learned how to operate leaner. Automation increases. Temporary contracts replace permanent roles. Productivity rises, but wages don't. This is why workers are hit last, too. Even when growth returns, bargaining power doesn't. There's always someone willing to work for less. There's always uncertainty to point to. There's always another crisis on the horizon. Then comes the quietest, cruelest math of all. Inflation often follows crises. Asset prices recover, prices rise, but wages lag. So workers lose jobs during the crash and lose purchasing power during the recovery. First hit, last to heal. Zoom out far enough, and this stops looking like bad luck. It's about incentives. The system is optimized to protect capital first, stability second, and labor last. Because capital is mobile, labor is not. Money can move across borders in seconds. Workers can't. That imbalance defines everything. It explains why policy reacts faster to market crashes than mass layoffs, why stimulus flows through banks instead of paychecks, why economic recovery often feels invisible to the people inside it. And that leads to the uncomfortable question: what happens when workers realize this pattern isn't temporary? What happens when the shock absorbers crack? An economy can survive inequality, it can survive cycles, but it struggles when the people carrying the risk stop believing the system will ever carry them back. Every crash leaves scars, not just on charts, but on trust. And the next time the alarms ring, the real question isn't whether markets will recover, it's whether workers will still be willing to absorb the fall again, knowing how the story usually ends.